There's so many different things to focus on, Paul, when it comes to Disney, but I guess the biggest part of it is how is Bob Iger, going to sort out these different pressure points from lower advertising revenue to the existential crisis of cord cutting to how he moves forward with Hulu, which they're contracted to purchase.
Well, he certainly has his work cut out for him. I think he took on this job knowing that it would be challenging, but he's faced challenges that I think nobody expected, like the writer's strike and some of the softness in the ad market. Maybe was expected, but it's probably more of a headwind than anticipated. And really just existential questions about the streaming business model, TV dwindling. I mean, he's pretty much said he's going to sell off those traditional TV assets. But that begs the question, is that going to be enough to finance the Hulu acquisition? As you noted, they're contractually obligated to do so, but the devil's going to be in the details with the price. So we'll see what happens with the valuation on that.
Yeah, we know that it will have to pay at least $8.61 billion, but they're still negotiating and trying to figure out the fair value of Hulu, and Comcast will probably put up a pretty stiff fight.
Yeah.
In terms of the Disney Plus business, we know that it added more subscribers than what analysts had been looking for, 150.2 million. Once that turns profitable, is that enough in terms of Disney's media side, especially if it's going to get rid of the linear assets?
Well, that is the goal, and Iger has said that end of 2024 is the target for profitability. I'll be really curious to see if those goalposts shift a little bit down the road. It's certainly a good indicator that they added more subscribers than analysts expected.
Yeah.
But there's a lot that goes into that business and a lot of competition. I mean, Amazon is launching an ad tier. There's just so much more competition in that space compared to a couple of years ago. So it's going to be a tough battle, but based on today's results, they seem to have made some forward progress.
I'm sure you know there's a lot of speculation in this market right now about what Disney's going to look like in the future, whether it is going to be this big entertainment conglomerate or, I guess, a bunch of different pieces. The fact that they seem to be focusing so much on cost cutting, the idea that they made this announcement about restructuring the individual units or the report, at least in the way they report them, and then, of course, the hiring of a new CFO. This is raising a lot of speculation here that they're basically just kind of painting everything up and getting ready for a sale. Do you buy that?
I do. I think the sale of the linear TV assets, the TV networks, I think is a given. But I think this is just basically...
To who? I mean, who would want them?
Well, that's a good question. I mean, private equity firms seem to buy up anything for any reason, so that's always a possibility. I mean, there have been a couple of bidders, and we'll see how that plays out. But I think this really is a precursor to what I think is going to be a broader sale of the business and possibly even breaking up the business into a media business versus parks and experience, maybe spin them off separately.
But I'm having a hard time understanding why that would unlock value, because I always thought the value proposition on Disney was the fact that it had these sort of different pillars that it could lean on. So if one thing did bad, something else would make up for it, not to mention the synergies, right? You make a movie, then you make a theme park ride off of it, you put it on streaming service. There were a lot of synergies there, and I'm wondering if they start to sort of separate all that, do those synergies sort of disappear?
They do disappear, and those synergies have fueled the business for 100 years plus a few days. But I think once Iger made that statement about the linear TV networks being a non-core asset, he sort of broke that model anyway. So now, from now on, it's really about the value of each of those business units separately. I mean, I'm not ruling out a sale of the entire company, and it's just a new owner with those phenomenal brands. But there are just so many things on the table right now for Disney that it's a really interesting time. Though he might describe it differently.
Interesting times for sure. I got to ask you about the parks business, because now that they've kind of reorganized, parks is housed under experiences. And in looking at the domestic revenue for parks, that rose, let's see, 7% overall for domestic, 55% for international. We know that there were shorter lines at Disney World this summer, as well as fewer crowds, and that fed this narrative that perhaps Disney overstretched when it hiked prices for tickets. Is this business as healthy as we think it is?
I think it's definitely going through some of the same pain points that the streaming business is going through in terms of trying to calibrate those price points and basically drive the business forward. I don't think that formula worked very well this past summer, although I wouldn't say that price alone was the only reason that people didn't go to the parks as much as was expected. But it is a tough business. They are better than almost anyone at running that business.
Yeah.
And Romain, to your point, it does depend on this sort of flywheel effect. So we'll see what happens going forward. But I mean, you know, having a bad summer is not great. Having a bad summer for the theatrical film business is not great, again, for that sort of flywheel effect. So I think Disney really needs to create great content, great experiences, and try to make that work across all of these businesses as long as it is an integrated business.
But with regards to some of the content, though, I mean, they've clearly taken a strategy that kind of less is more, right? The idea that you just focus on some of those key franchises, and that's how you do it, rather than Netflix, which just took the fire hose approach and just put out any sort of lame movie with the hope of just building up that library here. Do you think one model is better than the other?
Not necessarily. I mean, all of these businesses pride themselves on being data-driven, making data-informed decisions. But at the end of the day, nobody knows what is going to be a hit.
Yeah.
And if the new old Indiana Jones movie had been a phenomenal hit, then we might be having a somewhat different conversation. So a lot of it just comes down to how these things resonate. But yeah, they have definitely taken their foot off the pedal on content spending, partly because of the strike, but also partly because they're really in a cost-cutting mode.
Yeah. All right. Well, it'll be interesting, too, to see how long Iger sticks around, whether he can get this done in the time frame that investors think he's going to leave.
Right,
I mean, who knows? He may decide just to stay until whenever, right?
Yeah, another 5 years.
Paul, great to catch up with you.